Operating a testing, inspection, and certification business in California means managing intense speed, high stakes, and relentless regulatory pressure. State mandates from agencies like CARB and Cal OSHA effectively force your clients to use your services year after year. That mandatory compliance creates a powerful, non-discretionary revenue moat protecting your cash flow. But for an acquirer, those same state regulations represent a collection of potential liabilities that must be meticulously audited. The core issue is successor liability. When a private equity group or strategic buyer acquires your operation, they legally inherit every past safety failure, inaccurate test, and environmental misstep your company has ever made. This table outlines the dilemma. You see the left column, mandatory laws creating a secure revenue moat. Acquirers see the right column, exposure to successor liability, Prop 65, and non-transferable certifications. Historical revenue loses value if the compliance infrastructure is non-transferable. A generalist broker might understand your bottom line, but they often lack the technical vocabulary to defend your EBITDA multiples against a global TICC acquirer. When a buyer begins auditing your specific lab results and certification history, the deal can quickly stall without an advisor who understands the nuances of the California market. In the California market, inspection and testing companies typically trade anywhere from a 4x to an 8x EBITDA multiple. For a firm generating $2 million in earnings, that is an $8 million swing in your payout. Acquirers pay higher multiples when accreditations, safety markers, and client retention are tied to the firm's systems rather than the owner's personal presence. You have to ask yourself honestly, are you selling an institutionalized, scalable platform, or are you selling a localized practice that is completely trapped by your personal expertise? This chart shows how to prioritize the operational changes you need before going to market, weighing the required preparation effort against the ultimate impact on your valuation. A significant driver of value is shifting your income from project-based spot work to recurring compliance contracts. This requires a difficult operational trade-off. You have to actively turn down easy, high-margin one-off projects to focus your sales effort on locking clients into 12 to 24-month evergreen compliance agreements. By making that shift, you create a documented backlog and highly predictable annuity-style cash flow. Buyers pay premiums for that certainty. A more significant liability to address is the risk associated with your technical certifications. If your lab's ISO or ANSI accreditations or specific California operating permits are tied strictly to the founder's personal credentials, the business has near zero transferability. Buyers look at operations relying entirely on legacy, localized knowledge as a risk, heavily discounting them compared to modern, systems-driven firms. Fixing this means absorbing higher payroll costs today. You have to hire and cross-train a deep technical bench, so the company holds the expertise rather than the individual. Relinquishing daily control prior to the sale is a reliable way to achieve a clean, all-cash exit within 6 to 12 months, rather than suffering through a restrictive 3-year earnout. Distributing expertise across a broad technical team transforms your individual reputation into a tangible, transferable asset. Even with a strong team, you still face a grueling due diligence process specific to the California market. Acquirers will bring in technical experts to rigorously investigate your standing with state agencies like CARB, the Department of Toxic Substances Control, and Cal OSHA. A single pending safety citation or a past environmental failure gives the buyer leverage to demand holdbacks, keeping your payout locked in an escrow account for years. They will also scrutinize your Proposition 65 exposure. A history of inaccurate testing or invalid certifications makes your firm uninsurable, effectively preventing a sale. To mitigate these threats, you need to conduct a rigorous internal mock audit at least 24 months before you ever list the business. This forces a reality. The mock audit will uncover messy internal problems that require you to spend your own money up front on compliance consultants and legal counsel to fix them. Resolving these issues privately before a buyer begins their investigation removes their ability to negotiate the purchase price down later. Because the scrutiny is so intense, you must engage specialized representation, an advisor holding MNAMI or CMNAP credentials, who can defend your EBITDA multiples to private equity groups. Proactive, defensive preparation against state regulatory records is your most effective method for protecting the final payout. This checklist represents the criteria buyers use to evaluate your firm. They verify no single client accounts for more than 20% of revenue, and that accreditations are institutionalized across your staff. They demand proof of recurring contracts and a clean California audit history. If you're a strategic planner with 24 months before your ideal exit, your path is clear. Absorb the costs of cross-training your technical bench and formalizing your client agreements today. You are trading short-term operational friction for a significantly higher valuation at closing. If you are a founder who needs to exit in the next 6 months due to burnout or health reasons, you face a different reality. Going to market without completing this preparation means you must expect a heavily discounted valuation. To get the deal done, you may have to accept a structured earnout, tying your payout to an employment contract where you stay with the buyer for 2 to 3 years to ensure operational stability. Acquirers do not buy your past revenue, they buy the future reliability of your compliance infrastructure. In California mergers and acquisitions, cleanliness is profit. Do not guess your multiple based on top-line revenue. Get a specialized valuation, face your liabilities honestly, and fix them before the